All right, welcome to Financial Tangent, where we talk about all things money related. Introducing Rich and Ben here.
Absolutely. Welcome, everybody.
How's everybody
Hi,
doing?
everybody. Doing good.
Thanks, Chloe.
Yeah. Thanks for the intro,
So,
Chloe. Yeah, we haven't met in a little bit here, so it's good to be back and talking about
Mhm.
financial things. And I think we just got busy doing stuff. So, so
Doing
today,
stuff.
we wanted to do an intro on bonds, and from my understanding, it doesn't sound like they teach this stuff in college anymore, do they? I remember taking
we
having a whole chapter on bonds and like in accounting classes and stuff. What
we
about
we touched on it for a little bit, but more so from a management accounting kind of thing. Um, that was in business school, but yeah. So it'll be cool to learn about them because I don't know a ton. Um, I just know the surface level kind of thing. So
Yeah, I went to a party college in Michigan's Upper Peninsula, so we covered that apparently in our accounting classes. So.
Then
that's awesome. That's awesome.
we always joke because he went to Northern Michigan, where the N stands for knowledge.
That's right.
Oh, that's funny. That's funny. That's funny.
Oh man.
So,
So anyway, no, yeah, both at Northern and at Grand Valley. I remember covering bonds. So anyway,
nice. Nice.
yeah. So who wants to start out here? You want to talk about what's the definition of a bond?
Sure. So, just here's the overarching generic definition. And then I can kind of maybe let either Rich, you and Chloe maybe kind of discuss more about bonds from maybe like the corporate side. But the basic definition is a bond is a fixed income investment that represents a loan made by an investor to a borrower. The borrower is usually corporate or governmental, and bonds are used by corporations or governments to finance projects and operations. So the owners of the bonds are basically the debt holders or kind of like the creditors of the issuer. So that's kind of the overarching kind of definition that the three of us put together. And I can let you guys kind of talk more about it from the corporation kind of side or however else you guys want to.
Well, I was going to say that's something I feel like I can kind of relate to a little bit because in my like line of work, we do a lot with construction projects. And so to fund that, a lot of times they will issue bonds to like help fund the project, I guess. Which is I've seen
Absolutely.
some documents in different counties where they've actually like maybe in the 50s and 60s where they still have like those paper bond issuance like documents and stuff, which is kind of cool.
Oh, you see those at work?
Yeah,
Oh, that's cool.
not
That's
here
cool.
That's
in
neat.
not super often, but it's kind of cool.
Yeah, do
Yep.
they have the coupons on them too for like the coupon tabs or whatever that you
I don't think so.
yeah. Interesting though. That's really cool. So I mean basically, right, to sum it all up, you're a corporation and you need some cash, you need some money. Um, you're gonna sell a bond to an individual investor, to a mutual fund company. You're gonna put it out there on the general market, and then the trading floor is going to sell that bond to an individual, to an institution, something anything along that line. And so usually it's for it's a set amount, $1,000. Then there's a fixed price for that bond. 4 or 5. I'd have to look it up, but I'm sure the interest rates going up lately. Um, there's different interest rates for bonds, and a lot of that depends on the how risky the bond is, how risky the company is, how safe a bet it is for that person to purchase that bond, and that are you going to go, um, is your company going to fold? Is it going to go under? Then, they're considered junk bonds, and your your interest rate's going to be higher. It's going to cost you more to borrow that money from investors.
So in other words, like if I loan $1,000 out to company A, that's riskier, and company B is less risky. the interest rate on company A will be higher.
Yes, absolutely.
I have the potential to make more money from company A than I do company B.
Right, absolutely. And there's rating companies that rate companies and assess the risk of the company and, Moody's, trying to think off the top, I'd have to look it up, but there's plenty of rating companies and they'll make the news once in a while, or a certain company will make the news. Their rating, it just went
Just like
down.
to pay or something, or
Yeah, absolutely.
I'm sure it happens.
Yeah, definitely.
So but what if that company then either doesn't want the bond anymore, which, well, maybe that's not a very good way of putting it, but
Yeah, no, that's a really good question.
so then can the bond, just like a stock, because I'm able to talk about stocks more confidently than I am bonds. Can a bond be purchased back by the receiving party of the bond? Like, can the party that's like, say, for example, they either get money elsewhere or they get bought by another company, or they do go under and they start liquidating other assets to then pay off all their debts, and their bond is ultimately, one of their debts. So can a bond, what is that process?
If it's callable, if it's considered callable, they can call it back before the maturity date.
Okay.
And then they're still responsible for the interest that
Okay.
has, accrued. If it hasn't been paid yet, the interest that has accrued since the original bond purchase. But yeah, definitely.
Okay.
And there's callable bonds, there's non-callable bonds.
Okay.
If anybody has a Fidelity, any of the brokerage accounts, there's a whole bond section. Just you can go right there and poke around and look at different bonds. It's kind of fun.
Will I see a difference, like if one's callable versus not? How obvious is it spelled
It'll say
out?
right
And
on
then-
there. Yeah,
And
absolutely.
then it will. Okay. Because I also was thinking about too, like the return rate. So would the return rate on a non-callable differ than a callable bond? Would that be like, would I be paid more money for doing a bond that isn't callable, or does it just kind of depend on
That I
the
don't know.
situation?
That's a good
Would you say?
question. Yeah,
Okay.
right. Is there
Maybe we can maybe do some.
Yeah, we'll research that. We'll get back to everybody.
But I just was thinking about it, right? From the
Yeah.
sense of like, hey, like I want to make money. You know what I mean? Kind of
Right.
thing.
Absolutely. So yeah, that's a really good question.
Why would, like, when I'm talking like retirement accounts, right? Like we were talking previously, why would I do bonds maybe compared to the stock market? Would they, would that be because maybe they're considered to be less aggressive? I mean, even though we just talk about that they can be called back, or, the company that you're, or government that you're issuing them to could, have, financial issues, right? Like, are they still considered to be lower risk, or would you kind of equate them to be about the same almost?
As far as compared to the stock market?
Yeah.
Typically what happens is if it's a well-rated company, you purchase a bond, you have a really good chance of you're going to get your money back from that company.
Yeah.
If you're buying a bond from Apple or somebody that's super safe, or a municipality that's very well financially stable. It's going to be, it's a safe bet. The difference is that you don't get the same amount of returns as you would in the stock market, but you don't get the volatility.
Gotcha.
So,
Gotcha. So it's a little more kind of almost like a steady Eddie, maybe compared
yeah,
to,
right. Absolutely.
compared to a stock. The stock will do this.
Right.
The bond will just pay you X amount for that one bond.
Right. Yeah. Definitely. So I think people that if you need, it's something that it's more of a shorter term investment, then, you're going to want to buy a bond versus like a long term where you're going to keep the money in the stock market for many years. You're going to want to go in the stock market.
Neat.
So
Neat.
absolutely.
Gotcha.
Yeah. So we're talking about two, there's different types of bonds. We have variable or floating interest bonds. A fixed interest bond is the interest rate stays the same for the duration of the bond term. And there are variable rate bonds that would fluctuate with where the actual interest that gets paid fluctuates with the prevailing
Okay.
interest rate at the time. So,
Okay.
but I mostly have seen just fixed rate bonds. You're purchasing a bond, 5%, and you're going to get 5% for the duration of the bond. Let's say you buy a 5-year bond at 5%, you're going to be paid interest, and that interest terms are written out in the bond. So it could be quarterly, it could be annually, it could be the full length of the bond, and you don't get the
Sure.
interest until the end. And what's interesting about bonds is that if you purchase a bond for 5%, you can sell that bond before the maturity date on the just on the market on the basically on the, you just go through your brokerage account, you could sell that bond. Now, if let's say
Penalized?
hypothetically, I'm sorry, Cole?
Don't get penalized for that?
No, not necessarily. If interest rates go up and it's a 5% bond, let's say interest rates go up to 8%, your bond isn't going to be worth, you originally paid $1,000 for the $1,000 bond. Your bond at with interest rates being at 8%, your 5% bond is going to go down in value
Gotcha.
because you're going to have to entice bond purchasers to buy your bond versus the ones they can get at 8%. So, and there's formulas and stuff to figure out the exact the price of your bond and all that, but it's going to be worth less. But inversely, if you buy a bond at 8%, interest rates go down to 5%, your bond's worth more than $1,000. It's sort of a
Wow.
game.
Why would
So you can treat it like a just something like a house almost, right? And maybe that's a good segue into like my question is so you have like a mortgage. A lot of people in their kind of mid late 20s are looking at mortgages, right? And so when you talk about a floating rate bond, Rich, or it's almost similar to like when you go shop for a mortgage, you want to shop for the lowest rate, and obviously when you go buy, you want to shop for the highest rate. But it's like, so then are they almost similar in that nature where it's like you might have monthly changes in the what the market rates are, but then once you transact it, it's fixed. And for what I would now understand from our conversation, the fixed rate bond versus the floating. Now,
Oh, sure.
how often would the floating rate bond change? Would that be like a monthly or like a quarterly change? Almost. Maybe it would depend
I
on.
wonder if it would be daily, to be honest with you. They're not too popular, so I'm not too familiar with them, but I would assume a floating
Okay.
rate, with today's computer systems and things that absolutely.
Interesting.
Yeah. But
I think Chloe was.
Just to clarify, you're always going to get your $1,000 back at the end of the maturity. If you keep it to maturity, you always get your $1,000 back plus your interest. It's just that way. If you try to sell it prior to the, a lot of people, a lot of investors and stuff, they purchase them with the purpose of not necessarily keeping it to term, but to sell it prior to that, and they're anticipating interest rates,
Gotcha.
going down or
Gotcha.
So you had a question,
Chloe, I think Chloe was going to say something.
It is because I think this is hard for me to wrap my head around is if the interest rate on the bond goes down, why does that make the bond more valuable? If like, let's say you buy it for 1,000 and the interest rate is originally 8%, well, then you'll get back
80.
1,080, but if it's 5%, you'll only get back $50 or 1,050. So
You'll get your 1,080 back. Okay, even if interest rates go down because you were talking about a fixed rate bond, it's always going to be 8% through the duration of the bond. But if you wanted to sell that on the market halfway through, you're basically selling a bond at $1,000 and you're going to get, let's say 6 months into it, you've got $40 worth of interest left, right?
Mhm.
I'm thinking here. So you're basically selling $1,000 and $40 of interest to somebody that, if he were to buy a new bond at 5%, would only get, for 6 months, would only get $25. So basically you're,
Oh,
you know what I mean? And so now that bond's really worth an extra, what's it, $15 because
gotcha.
you're getting a better interest rate. So that bond's really worth another, we're talking about 6 months into the bond, it's worth another $15 to a buyer.
So
And
you're
Gotcha.
better off
for
with-
not doing anything, right? For just purchasing a bond, you've made, obviously now if you extrapolate that over bigger dollar amounts, right, you're going to get some better return on your investment.
Gotcha.
So, and it's also like what the market is doing versus like what my bond is. And so that's it's so, because I remember first kind of looking at these maybe, I don't know, like maybe a few months ago, a year ago, you know what I mean? Kind of just exploring, you know what I mean?
Absolutely.
Kind of around the time that we were kind of pioneering the idea of the podcast, right? And
Right, sure.
so my understanding is it's an intangible asset, but you can treat it like a tangible asset and pass it off to other people. You can't really do that with stock. At least I don't. You might be able to, like, move like a inherited, trust or something like that, but you can't. Yeah, you can't. I don't think you can. Yeah, I was just saying, I don't. That's something unique to bonds that I'm kind of hearing, that you can
Sure.
resell it.
Right,
Just
absolutely. No, I encourage everybody, take a grand, if you have an extra grand, buy a bond, buy a 6 month, buy a year bond.
Yeah.
Absolutely. So, find nice rating, AAA rated, AA rated, something in
Yeah.
the A's,
Yeah. I wouldn't do anything in like the B series bonds.
right,
That
exactly.
would not be good. Yeah. Um, is there like a seasonality to bonds, Rich, that from your experience that you see, like, are there good times to buy a bond or bad times? Or I guess we just touched on like how to find a quality bond. So say I find a quality bond, but then now it's like, okay, is it a good or bad time? You know what I mean? Like, with stocks, you can kind of time it based on corporate earnings season, stuff like that. But what does that look like?
I honestly don't know. I think the only really good time to buy a bond is if you anticipate interest rates going down, because your bond will be worth more on the market.
Gotcha.
Absolutely.
Gotcha.
Yeah. And I think, sometimes too, if the stock market's doing bad, investors tend to dump more money in the bonds and bond funds, things like that. So it's there's some of that going on as well. But I think
So
really,
would you say there's some inversion between those two, like the stock market and the bond market are kind of inversely related, but maybe not always entirely?
definitely. Yeah, right. That's probably a good way to put it. Typically it's, if the stock market's doing bad, people invest more in bonds. And if interest rates start going up, people have a tendency to want to purchase bonds because of the higher interest rates. And
Gotcha.
interest rates go down, people want it, they're not as enticed to purchase bonds because of lower interest rates, so they'll put their money in the stock market instead. So I think a lot of it has to do with it, the almighty Fed and how they dictate interest rates. And I still want to do an episode on the gold standard. Anyway, let's
let's do it.
Andrew Jackson and the Federal Reserve. Anyway,
Yeah,
but
let's do it.
A lot of it has to do with the Federal Reserve. If they raise interest rates, bonds are more appealing because you're going to get more return for your money. So money will go in the bonds and bond funds, and then the stock market won't. And the higher interest rates are slowing the economy down, so the stock market does poorer. Versus like now it's an election year, so you'd expect interest rates to go down because it'll heat up the economy and make the incumbent politicians look good. So interest rates will go down, which means stock market, the bond market won't be as appealing but the economy heat up, so the stock market will look good, earnings will look good, and
Gotcha.
things like that.
Gotcha.
Typically,
Huh.
it'll be a crazy year. This year will be a crazy year, but hey,
Oh yeah. Oh yeah.
what else did could we cover everything we wanted to cover? Or what?
I think,
I had,
yeah. Chloe, what's up?
okay. Theoretical question.
Sure.
Ben, you and I are young, just starting out in our careers.
Yeah.
How much would I or should I invest in bonds versus stocks at this point in my life?
Great question. I'd ask the same thing too.
Because I feel like there are rules, like, for example, in this book, this is a Personal Finance for Dummies book by Wiley Brand, where they say you could play it safer and do 100 minus your age, and that's your stock allocation, and your age is your bond allocation. Or you could do your age minus 10, that's your bond allocation. Or if you wanted to be aggressive, you could do your age minus 20, and that would be a
Writing
bond.
this down here.
Gotcha.
Good stuff. Yeah.
Because I've thought about that too, and Dad, we've had a conversation about this where why, like, what is the benefit to me? Because we are, like, Ben and I are so young.
Right.
If the stock market goes down, are we really gonna care? Because we can ride it out. You know what I mean? Like, we're
Absolutely.
not touching our money for the next 40 years.
And you kind of want the market to go down because you're in a buying stage right now. You'll get more
Mhm.
you'll get more stock shares and more mutual fund shares and ETF shares for that dollar, every dollar you're investing. You
Yeah.
want the market to go down.
I would say that, like, personally right now, I mean, so I'm 24, right? I do everything that I'm able to do is stocks or indexed funds of stocks of the S&P 500 or
Yeah.
whatnot. I think I've seen, like, that managed or targeted funds will change from stocks to bonds. Work sometimes people talk about that, like, oh, what are you doing in your retirement account right now? And I haven't spoken in those conversations because I just don't really like to talk about it at work, but B, I also just am new to this, right? So
Sure.
you know like I had two coworkers previously. One of them was maybe 5 or 6 years away from retirement, and he's still pure stocks doing that. And another one, is maybe 20 or 30 years from retirement, but he's starting to do more bonds too. So I feel like it might be like a personal risk factor, like what you're comfortable with.
Yeah.
But those managed or targeted retirement funds, like we previously talked about, if I'm understanding, correct me if I'm wrong, Rich, will switch over to more bonds and kind of maybe follow that formula that Chloe kind of
Absolutely.
talks
Once
about.
you get the retirement, they'll yeah, absolutely. They'll invest more into
Because
bonds.
I can see, like, the closer you get in age to retirement, that you would want to maybe not want to feel like the volatility of the stock market, like you kind of want your money locked in. But like, if the stock market is volatile now, to me, I guess it doesn't scare me because I know I'm not touching my money for the next 40
Right.
years.
Absolutely.
Right.
So,
Right.
so yeah, I guess Ben, you answered the question well, as it personal preference. There is really no golden rule. It just depends on what type of risk you want to take.
Yeah, it's nice having a guaranteed return though. And I think, like, maybe in another episode, I'd love to, like, because I know Rich and I have talked about, like, while road biking and stuff, like bond ladders and like doing that.
Mhm.
And I think it's basically where you kind of stagger the timing of the bonds, then you do like, you take a sum of money and then you buy a bunch of bonds and you kind of like stagger them. I could be wrong, Rich. I
Yeah.
think
So the maturity
if I'm
date is
remembering,
staggered, so
I'm remembering what we were talking about.
Yeah,
But
definitely.
that'd be cool to
Yeah.
maybe we could talk more about that in another episode for viewers. If any interest. But my only other thought was like, is our bonds insured by like any sort of like, are they FDIC, or are they like, are they, is there some sort of assurance behind them? I mean, because with stocks, it's like you read like this much, super fine print about this is
Right.
not insured by the FDIC, and this is you are inherently taking a risk, and blah 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 blah. And so,
Mhm.
I don't know if I can't say for sure, but are bonds insured by the FDIC?
If it's a corporate or from the a municipality, they're not.
Okay.
Now, if you buy a bond, basically a treasury bill is a bond from the U.S. government. Now that'll be insured. They'll back that up.
Okay.
I mean, they've got they'll never default on that bond because they'll just go to the U.S. Treasury or the Federal Reserve, and they'll just print more money to cover the interest on the bond. So they'll never.
Gotcha.
So,
Gotcha. Gotcha.
sorry, all
Gotcha.
this inflation,
Yeah. Right. No,
So-
yeah.
Anyway, but yeah, so anything it's T-bills and it's at I bonds. There's some, and we should get more of those in future episodes. Those are backed by the U.S. government, and those will, uh,
Nice.
those will be safe, but you're not going to
Nice.
get much interest as you would from a corporate bond.
Gotcha.
And then real quick, not to go into too much detail, but municipal bonds are for municipalities. Let's say we voted out a millage increase in North Muskegon here, and that they would have, if that would have went through, they would have sold bonds.
Yeah.
And that
So-
was
That's how they
considered a
do a lot of
municipal
those.
bond,
Yeah. Yeah.
So
And
if
the-
that went through, then like you and I, we could purchase those bonds to help fund the project, basically.
Yeah, absolutely. So
Neat.
yeah,
Neat.
you could
That's
have
cool.
funded it. You almost could have funded an AstroTurf football field. So
Yeah.
and the key with
Yeah.
I kind of went off on a tangent here, but
Oh,
municipal
hey,
bonds.
that's the first one of the episode, and
Right,
we kind of got the meat and potatoes of our discussion done. So
right.
we're doing good.
Absolutely.
I gotta say, it's kind of one of those, bonds are interesting, right? They're there, right? And there's always opportunity. And so it's like, I mean, it's also kind of like a time is on your side kind of thing. Because if you take some money and do a bond and then it grows a little bit, and it's kind of like that A equals P times E to the RT equation, where you just have time and compounding on your side. You know what I mean?
Right.
So bonds are intriguing for sure.
I
Absolutely.
think it's really cool how, like, I, as an individual, can loan out my money, similar to how there are like loan companies that loan out their money and they expect interest, and I can do that. Just
Mhm.
any type of what's it called, like Charles Schwab or Fidelity or something, and
Yeah.
get interest back myself. I think it's kind of cool.
Yeah, it is absolutely. Yeah, find a company you like, and you buy a bond from them. It's kind of neat. So,
Mhm.
absolutely.
Chloe, is it getting to be that time of the podcast?
What would you do?
Yeah. What would you do?
So the question is, in your retirement or brokerage accounts, what % of your investments go towards bonds, and how old are you? Which we already answered, and I didn't realize that was what I had picked previously, but I think we answered that.
Yeah, we did. Well.
I'll come
We
up with
did well.
something more interesting next week.
Yeah, that's okay.
But it's interesting because you look at like the psychology behind the bond market, right? It's like here's this bond, here's what the rest of the market's. I feel like it's just so much more numbers than maybe it is emotionally driven, because you have like brands and, CEOs and political stances of companies involved, I feel like, when you have stocks. So I feel like that can make the stock market incredibly emotional, maybe compared to the bond market. And so if,
Yeah.
maybe if you're an anxious investor, maybe doing bonds are good for you, because then you're not worrying about all this other stuff. Or if you're somebody that you don't want to pay attention to the news or pay attention to the, what's going on with, any, specific stock, if that's your route, maybe bonds are better for you. You know what I mean? That's just a random thought that I'm kind of putting
It
together
used to
right
be, if you
now.
go back to the 80s when interest rates are 18%, you easily could have just.
Oh my,
Oh my God. Oh my God.
what a time.
Yeah. So it's May 2024 when we are recording this right now. And yeah, well, man, even you look at like 2019 versus 2024 and like the changes on the graphs and everything that we see. And so it's like, whoa,
Right.
18%. Whoa.
Yeah, ask your grandparents about the
So-
80s and
Yeah.
I think we
Yeah.
brought this up in a previous episode. Grandma told me what the first house price that she had purchased was $15,000.
Wow.
Oh my goodness. You can't even buy a brand new car for $15,000. I know you can get one for 19. It's it's from Nissan. It's one of their smaller cars.
Oh, the
And
Versa
they're
or
the only-
something.
they're the only one for under 20K for a brand new car.
That's it.
Wow.
I didn't,
Somebody was talking about that, and I remembered, I picked up on it. But
Really cool.
it's insane, right? How time changes. It'd be cool to do an episode on, maybe we could do one in the future on purchasing a home or something like that.
Sure, I'd love to.
But if
Absolutely.
you're listening to this, let us know in the comments. We're working on I'm trying to get us on Apple Music or Apple Podcasts as well. So that's coming. Believe it or not, I have to do some sort of logo with a certain type of resolution to be able to finish publishing our channel. So I am working on that. So that's coming soon. But I appreciated the discussion today. I thought
This was fun.
very, very informative.
Yeah,
because
definitely.
No
My only
info on it.
advice is just take $1,000 and buy something and have fun with it. So I wouldn't buy anything 10-year or 20-year or something crazy like that, because it's at that far out. It's the professionals. Leave that to the professionals. Buy something that's 6 months, a year. So
Nice.
you always get your money back if it's a safe, if it's a good credit rating. And
Mhm.
Nice. So kind of takeaways would be, stick with anything in the A's, do 6 months to a year, kind of get started, and kind of understand, that you can resell the bond, or it could be called back, but you're really not losing a ton if it's called back either, because that interest will be depending on it. If it's a callable, right? If it's a callable, that's something else. So
excellent, you guys.
cool.
Great discussion.
Thanks, guys.
Yeah.
I like your Northern Lights, Rich. That's awesome.
Oh, thanks. Appreciate it. Yeah, it was at a messy office. And the blurring background just didn't quite, obfuscate.
I gotcha.
So I had to.
I gotcha.
Cool.
So, well, very cool. Thanks everybody for joining today.
Thanks everyone.
And we look forward to catching you all on the next episode.
Take care, everyone.